Hi, I wanted to take this time to update you on what's happened in the markets this year. Certainly, our investments are somewhat in the markets, some maybe in real estate investment trusts or Delaware statutory trusts on the real estate side. Some of our investments are more like pension plan type investments, like in a fixed index annuity with cash flow for life. But today I'm going to focus on the part of the investment that's in the global stock and bond market. And so I just want to give a recap on that. Through the end of last month, I wanted to cover the returns of some of the major indices. First, the S&P 500. It's been a wild ride for it this year, and in the end, through the end of October 31st, it was up 1.5% for the year. Now, remember, the S&P is dominated by tech stocks, so that kind of skewed the results a little bit. As we look at other areas of the market, Europe, Asia, and Far East, the developed foreign markets are down about 10% year to date. The emerging markets, China, India, Russia, Brazil, that kind of thing, they're even for the year. The Dow itself, the Dow Jones Industrial 30 stocks, is down 6% year to date through the end of October. And the most encompassing of all these indexes is the Vanguard All World Index. That's a US, developed foreign, and emerging markets. You put them all into one big fat mutual fund. What do you got? You're down 7% year to date. But thankfully, we had some moves that were not just general broad market. The comparison to this is the NASDAQ, which through the end of October, which is technology heavy, is up 27%. So if you own technology stocks, healthcare type stocks, telecommunication stocks, you were fine. You made money. If you own the rest of the market, you weren't so fine, probably. You would have lost money. So if we look at the all world index being down 7%, I'm sure you'll agree most of us are pretty happy with our returns this year to date. As you look at your statements, likely you're up. The reason for that is we made some moves early in the year that were good early in COVID. But currently we have overweights. Overweights meaning we're heavier in certain areas of the market, which by definition means we're lighter than in every other area. So the areas that we're heaviest in the market is the most of the models will have this. The bigger models will have the NASDAQ QQQ, which is all the big tech names. Then we have a software ETF we've specifically added to the mix to overweight software. That's got mostly Apple and Microsoft in it. Then we overweighted semiconductors. I joke that even my toaster has a chip in it anymore. So semiconductor stocks are an overweight. Biotech is still an overweight for obvious reasons. Telecom, obviously communications, big post-COVID world. An allocation to gold as a defensive strategy. And finally, a momentum-based ETF. They buy stocks that are increasing in value not without regards to their underlying valuation, think Tesla, that kind of thing. So those are our overweights, meaning that we're underweight in the foreign areas of the markets. Bonds, we primarily use fixed index annuities as a bond substitute. And then we're underweight in anything that isn't technology, healthcare, or telecom. So think banks and any of the consumer areas, energy stocks, of course, so those materials, that kind of area. So that's where we're underweight, but heavily weighted more, again, to technology, healthcare, and telecommunications, US stocks primarily. We did add mid-cap and small-cap stocks back in after the last go-round. They took a hit during COVID, and we missed most of that, thankfully, and now we're back in. But I thought it'd be interesting to talk about, you look at these exchange traded funds, you go, okay, what am I invested in? It says iShares, it says Vanguard, it says, Spider. What does that even mean? I'm buying spiders? I don't know what that means. So I did a breakdown of our most popular model, the growth model, and I just wanted to read off in order, top to bottom, the top 20 or 25 shares, stocks that you own when you own this ETF. So if you own all of the ETFs in that model, which you would, if you grouped them all together and did the math, which companies do I own the most of? So that's what I'm going to go over right now. So the biggest holding you have is Apple. Second is Google. Then it's Microsoft, Amazon, Facebook, Nvidia, Tesla, Netflix, Johnson & Johnson, United Health, Adobe, Texas Instruments, Amgen, Intel, Visa, Costco, AMD, Qualcomm, Comcast, Broadcom, Eli Lilly, Verizon, PayPal, Charter Communications, and Procter & Gamble. So those are the companies that you're actually invested in. There might be Apple might be in 6 different ETFs that you own. Tesla might be only in 3 or whatever. But that's kind of the breakdown. I think it's helpful when you're looking at these statements. None of the names are all that recognizable, just because they're just ETF names that hold baskets of stocks that are always moving. So it's helpful, I think, to just kind of read down the list and say, oh, okay, I've kind of heard of some of those companies, and maybe you get a sense as I read that list that, yeah, that seems like a good place for me to invest, especially post-COVID world. But you can certainly sense the overweight I have. I didn't mention Chevron or Exxon or a lot of other companies you might have expected might be near the top because they've been replaced with our overweighted sector rotation strategy. Again, we use fixed index annuities as a bond substitute, so we don't have a lot of bonds in our general portfolios. And we use real estate investment trusts and DSTs for growth and cash flow. And we also use fixed index universal life as a great gifting strategy, a legacy strategy, or tax-free cash flow in retirement. So it can be used in a number of different ways. So certainly, I've talked about that on previous messages I've done before, but just kind of wanted to update you as you think about, well, how am I doing relative to the globe, and am I in the right areas? Certainly, with the all world index of stocks being down 7% year to date, I trust you can look at your statement and make a good conclusion from that. And by going through the different sector overweights, maybe feel a little more up to date on how your investments are going forward. We still there's still some work to be done on who's our president and all of that, and we don't even know who's going to be in charge in the Senate. I suspect, though, if the Senate goes Republican, all of the most of the Trump tax breaks and the last tax law will relatively stay the same. We're not going to see the progressives policy get through the Senate if they pick up one seat in the Senate from the Georgia runoffs. And so that's my expectation at this point in time. And so I think Wall Street would see that as a good thing, that we're not going to see a lot of change. Wall Street doesn't like change and volatility. So that could be a good thing, regardless of who is sitting in the Oval Office come January. So that's my update right now, and I hope this helped answer some questions you might have about your portfolio. There have been a lot of changes this year, and hopefully that summary was helpful. I do encourage you to look at your next statement as it comes out, or your last statement, because I'm actually speaking through the end of October right now, and take a look at that and compare it to what I mentioned. And hopefully this is helpful, and let us know if you have any questions or want to talk to us about some adjustments or updates to your portfolio. Thanks again.